Hi everyone, my name is Michael Tyrala. I am a postdoctoral fellow at the Institute for Emerging Market Studies of the Hong Kong University of Science and Technology. And before I go any further, I would like to thank you very much for tuning in under these exceptional circumstances. And I would also like to extend my gratitude to the AG organizers and especially to Zachary Neal for putting this panel together and making these presentations possible in the first place. All right, let me get my presentation ready. Okay, here we are. So today I will be talking about World City Network analysis and what I refer to as its curious omission of offshore tax dodging, and also about why this omission is a problem worth discussing and addressing. According to Peter Taylor's World City Network analysis and the three-layered interlocking network model, cities operate as key components of the global economy, and relations between cities are constituted by a set of core-forming processes tied to the everyday activities of advanced producer services firms, which organize, manage, and control virtually all cross-border flows characterizing the capitalist world economy. Since the publication of the original text, a lot of excellent work has been done using this methodology, but arguably its most impressive application to date has been Peter Taylor's and Ben Deruder's recently updated mapping of the office networks of 175 firms in the accounting, advertising, finance, law, and management consultancy sectors, and the consequent identification and ranking of 526 cities which make up the World City Network, and it is this work that I will be focusing on in this presentation. In my view, World City Network analysis remains one of the most exciting and promising approaches to understanding contemporary globalization. However, and this is my main argument in this presentation, as it stands today, its explanatory power and potential are undermined by its omission of offshore tax dodging, which at the subnodal level leads to the underestimation of the network sizes of a large proportion of the firm sample, which then at the nodal level leads to the underranking and even exclusion of several major tax havens, and ultimately at the net level to a skewed understanding of the global economy and its change trajectories. It is a simple argument, but I think one that is very important and worthy of further elaboration. Unfortunately, given the secretive nature of offshore tax dodging, the argument can only be substantiated in a number of indirect ways, which I believe, however, combine to be quite persuasive, and hopefully by the end of this presentation I will have convinced you as well. The presentation is divided into three sections. In the first section, I touch on some of the key terms related to offshore tax dodging and demonstrate why it should be considered a crucial core-forming process that nowadays plays an immensely influential role in virtually every facet of the global economy. In the second section, I demonstrate the relevance of offshore tax dodging for World City Network analysis and its interlocking network model on the example of the seminal work of Taylor and Deruder. And in the third and final section, I discuss a few specific ways in which the omission of offshore tax dodging could be rectified without adding an undue amount of workload to what is already complex and time-consuming methodology. All right, so let's begin with offshore tax dodging. Offshore tax dodging is the umbrella term for tax evasion and avoidance using secretive offshore structures, which means that it pertains specifically to the kind of sophisticated grand-scale tax dodging that is almost exclusively perpetrated by wealthy individuals and multinational enterprises, since they are the only ones that can afford to pay for the services offered by tax havens and the intermediaries from the accounting, law, and finance sectors, without which none of this would be possible. To understand how offshore tax dodging works, it is important to clarify that while the term offshore generally connotes a geographical category, in the context of tax dodging, it is actually a legal one. As such, offshore tax havens are essentially legal spaces that decouple the relocation of the economic transactions from the legal location and hence remove the tax liability of the transaction from the place where it actually occurred. They are highly specialized jurisdictions that offer a variety of services to help wealthy individuals and MNEs dodge taxes, with most offshore tax dodging schemes requiring the interplay of several specializations from several jurisdictions. One example of this is the famous double Irish with a Dutch sandwich scheme, which involves 5 countries, 3 of which serve as offshore tax havens in this particular case, namely Ireland, Netherlands, and Bermuda, but only the last one of which is geographically offshore and commonly known as a tax haven. So the key takeaway here is that offshore tax dodging relies on a network of tax havens, which, very much in line with World City Network analysis, is formed by the offshore intermediaries from the accounting, law, and finance sectors that create the offshore tax dodging schemes on behalf of their wealthy individual and M&E clients. However, another key takeaway is that there is a hierarchy among the intermediaries. Those on top of the food chain generally create the schemes, but in order to reduce liability, should something go wrong, they often have the schemes be carried out and maintained by a multitude of smaller, specialized, and much less known offshore services providers that are independent from them, but form a crucial part of their network. The most exhaustive documentation of this state comes from the Panama Papers leak data, and specifically from Mossack Fonseca, the Panamanian law firm at the center of the leak. In one of the now scrubbed statements addressing the Panama Papers media coverage, the firm defended itself by pointing out that, one, it does not advise clients on the structuring of corporate vehicles and the use they may make of them. Two, that its clients request services after being advised by qualified professionals in their places of business. And three, most tellingly, that approximately 90% of its clientele is comprised of professional clients, such as international financial institutions, trust companies, and prominent law and accounting firms who act as intermediaries. Now that we know a little bit about how offshore tax dodging works, let's take a look at what available data has to say about its size and impact. To start with, as of 2015, somewhere between 7.6 to 32 trillion of untaxed financial wealth has been parked offshore. This stash grows by somewhere between 200 to 850 billion annually and represents 3 to 13% of the total global wealth that has been historically amassed up to that point. Next, according to voluntary disclosures, most of the M&Es from the Fortune 500, the FTSE 100, and the ASX 200 reported that they operate tax haven subsidiaries, and numerous studies have shown that this strongly correlates with their lower effective tax rates. Furthermore, almost 40% of all foreign direct investment is estimated to be completely artificial, likely done for tax purposes, and the growth of this phantom FDI even outpaces the growth of genuine FDI. As for the impact of all this, it goes far beyond the revenue side, with offshore tax dodging also exacerbating income and wealth inequality, perverting market competition, undermining macroprudential and microprudential supervision, and much more, all of which enormously contributes to macroeconomic and financial instability, with studies even showing that offshore structures played a significantly negative role in every single financial crisis in at least the last 40 years. Okay, so in the previous section, I established three important facts that indirectly substantiate my main argument. First, that offshore tax dodging is a phenomenon that is absolutely massive in terms of size, impact, and in just how widespread it has become. Second, that advanced producer services firms from the accounting, law, and finance sectors serve a crucial role as intermediaries. And third, that these intermediaries manage sprawling hierarchical networks reaching cities in a variety of tax havens that at first glance and by a variety of conventional metrics may appear peripheral, but in terms of offshore tax dodging are anything but. In this section, I will substantiate my main argument further and more explicitly by demonstrating the relevance of all this specifically to World City Network analysis and its interlocking network model as represented by the seminal work of Taylor and de Ruyter. I will begin at the subnodal level with the 125 largest accounting, law, and financial services firms that make up their sample, and then I will work my way up to the nodal level made up of the 526 cities. So of those 125 firms, 26% appeared on the list of the 140 most prolific intermediaries featuring in the Panama Papers, the offshore leaks, and the Bahamas leaks. This includes 11 accounting firms, including the Big Four, 21 global banks and financial services firms, and one law firm. This means that the authors underestimated the network sizes of at least 26% of their sample. And this percentage is very likely just the tip of the iceberg, considering that it includes some of the world's most prominent firms from their respective sectors, and that the entire database used in this comparison was at the time built on data from only 3 firms and the corporate register of the Bahamas. The accounting sector is especially interesting here because it is not only the one most exposed to offshore tax dodging, but also because it is arguably the most misunderstood one. For example, World City Network analysts have understood the apparent key role of accounting firms as being tied to their core competency in auditing, through which they provide an important element of standardization to the capitalist world economy. However, this is an increasingly outdated view, given that the tax and advisory service lines have grown faster and have captured a higher share of the overall revenue than auditing, and these trends appear to be representative of the entire accounting sector, if by nothing else than the sheer global dominance of the Big Four. Of course, as stated in my main argument, underestimations at the subnodal level naturally spill over into the nodal level in the form of underrankings and exclusions of several major tax havens, and this is evident when we take a closer look at the 526 cities. With 526 cities in their list, the authors of course inadvertently managed to include dozens of major tax havens. However, their list is nevertheless conspicuous for its exclusion of 28 of the most secretive tax haven jurisdictions. Among the exclusions were such heavyweights as Jersey, Liechtenstein, Malta, and even the British Virgin Islands. The exclusion of the BVI is especially shocking for at least two reasons. The first is that its vehicles collectively hold as much as 1.5 trillion in assets, and they accounted for 53% of the 200-some thousand offshore entities that appeared in the Panama Papers. The second reason is that the authors actually paid considerable attention to the rise in connectivity of Chinese cities, but due to their omission of offshore tax dodging, they missed the huge role of the BVI in the China-Hong Kong BVI nexus, and huge it is. Consider, for example, that over 40% of that 1.5 trillion belongs to companies from China and Hong Kong, that 75% of Hong Kong's Hang Seng index is made up of companies with direct linkages to the BVI, and that the volumes of FDI mediated through these very same vehicles dwarf the volumes of any other jurisdiction aside from Hong Kong. Here's a look at China's inward and outward FDI that illustrates BVI's role very well, being second only to Hong Kong for most years and occasionally edged out by the Cayman Islands, but always far above the likes of USA, Japan, or Australia, and this for a jurisdiction with a population of roughly 31,000 people. Now, as I said at the outset, given the secretive nature of offshore tax dodging, the argument could only have been substantiated in various more or less indirect ways, but when combined, I do believe they paint a very clear and sufficiently conclusive picture. Other critics cited arts, data management, logistics, consumption, and other facets of the global economy as the missing items in World City Network analysis. To this, Taylor and DeRuder responded that while these are important, they are less central to the nature of cities in globalization and are not quite reflective of core forming processes. I think they were right to stand their ground. However, the same response simply cannot be made against offshore tax dodging, which is absolutely central not only to the kind of corporate globalization that World City Network analysis is attempting to capture and explain, but also to many of the advanced producer services firms that World City Network analysts consider to be the primary agents of this globalization. A more valid argument would be that there simply isn't enough data to effectively incorporate offshore tax dodging into World City Network analysis, but that argument is losing its potency every day, and World City Network analysts have in any case already been taking certain necessary and legitimate methodological liberties in terms of information gathering and data production. In terms of data, the ICIJ's offshore leaks database is being updated with every new leak, and there are a lot of them. Another excellent source could be public country-by-country reports, which are already available for financial services firms operating in the EU, and this will soon very likely be extended to all large M&As operating in the EU. Then there are public beneficial ownership registers, which are currently being set up in every EU member state, as well as several other jurisdictions, including in many tax havens. In short, immense regulatory pressures have begun making the offshore world more transparent, and there are many more examples of this and thus many more useful sources of data. However, until such data become more consistently available, at the very least, simple checks should be performed against either the relative population sizes in firms' office locations or the relative GDP sizes in their office locations, or even both. For example, the Big Four are heavily overrepresented and disproportionately active in tax havens, even when one controls for the possibility of small country bias. Running such simple checks and adjusting office rankings accordingly would ensure that the profiles of many of the most secretive tax havens would be increased and made more in line with reality, rectifying the current situation in which many jurisdictions appear to be peripheral based on their city ranking, but in reality are anything but. This is undoubtedly a huge challenge, of course, but I think one which will have to be taken up soon if World City Network Analysis is to retain any of its still considerable explanatory power. Doing nothing would not only mean committing to a multi-trillion-dollar era of omission, but worse, it would contribute to perpetuating an extremely skewed narrative about an important chapter in the unfolding history of globalization itself. Now, with that said, I would like to thank you very much for your attention. And if you have any questions or comments, please do not hesitate to reach out to me. Thank you. Take care.